A year ago, everyone was talking about Washington, D.C. It was the hot market du jour, a surefire bet, but now that appetite has really dropped off. Some of the REITs recently announced less than expected rent growth there. The job numbers have turned out to be pretty underwhelming for 2011, and now some of the equity analysts are projecting basically flat rent change going forward. What is happening in the nation's capital? We'll take a look. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Washington, D.C. update. We're going to do something a little differently than we usually do on Apartment Market Dynamics. We're going to make a case for why some of the concerns about Washington, D.C. have gone over the top and why this is still a very healthy market. First, let's take a look back at what happened in 2010 that built up all the hype. At the end of that year, D.C. was #1 in the country for job growth, 5th for apartment rent growth, and among the nation's leaders for occupancy rates as well. And here's what happened in 2011. As you can see on the chart, job growth disappeared, net change is basically zero, rent growth came in at 4.7%, which is actually below 2010 levels, and occupancy held pretty steady, coming in at 95.7% at year end. And those are numbers that actually disappointed many people. So, is that disappointment justified? We don't think so, and we're going to give you 4 reasons why. Number 1, bloated expectations. In 2010 and the start of 2011, we started to see reports of record sales prices for property transactions in the D.C. market, and that led to plunging cap rates. And many of these deals were based on pro forma rent growth expectations of 7 to 8% growth every year for essentially perpetuity. Well, that was the big problem, is some of the expectations were simply over the top. Take a look at this chart showing annual same-store rent change in D.C. over the past decade. D.C. hit 5.5% at the end of 2010, and that tied the metro's high for over the decade. And when you look at what was normal, it was even less impressive than that. Between 2002 and 2007, which by the way was a period of near constant job growth, D.C. averaged year-over-year rent growth of just 2.8%. And in the long run, we know that markets usually return closer to their means, and so in hindsight, it wasn't too surprising to see rent growth levels ease a bit. But 4.7% growth in 2011, a year with basically no job growth, that's not too bad at all. But basically, D.C. is not a market like New York or the Bay Area that are accustomed to seeing big rent hikes, and it seemed unrealistic to expect D.C. to all of a sudden change its character and post big rent hikes going for years in a row. Number 2, the economy is still in good shape. Yes, D.C. came up empty on job growth in 2011, but take a look at this graphic. This is showing you the top 5 markets in the country for net job change since Q1 2008, just before the recession hit. And there's D.C., #2 nationally behind only Houston, nearly 4,000 more jobs today than it had prior to the downturn. So, all in all, D.C.'s economy is healthier than most, and if we were to look at only job change among young adults, those numbers would look even better, and of course that's significant because young adults are more likely to rent. Number 3, apartment numbers are strong basically everywhere. We broke Washington, D.C. down into 35 submarkets to drill deeper into what is happening, and guess what? The numbers are still at least decent, if not great, across the board. Rents are up 9.2% year over year in the heart of D.C., that central D.C. submarket. They're up 8.5% in North Arlington. And the slowdown in rent growth was actually more concentrated in the suburban areas, and even there it was kind of hit and miss between certain spots. And compared to what we're seeing in other parts of the country, rent growth numbers in the suburban areas of D.C. weren't bad at all. And looking at occupancy rates, in 32 of those 35 submarkets, occupancy is right near 95% or better. And so very little vacancy issues in the D.C. market. And number 4, development is picking up, but not that much. One of the big reasons D.C. skeptics cite for their concerns about this market is that new supply levels are ramping up again. But let's put those numbers in a little bit of perspective. Take a look at this chart showing 12-month new supply levels by quarter. You can see that nearly 4,200 units are projected to complete in 2012. Yes, that is bigger than most markets, and it's more than what completed in 2011, but it's not that much relative to D.C.'s recent history. Between 2000 and 2010, D.C. averaged nearly 7,000 new units every calendar year. And by that measure, 2012, those numbers are still going to be pretty small. And put another way, the total apartment base in the Washington, D.C. metro will expand just 0.8% in 2012. Now, it's important to note that permit levels are picking up again to some larger numbers, but most of those projects, if they're actually approved, won't get built until 2013, 2014. And by that point, we're expecting to see stronger job growth, and with occupancy rates already very tight, those construction levels shouldn't be that big of a concern. So with all that said, here's the bottom line. We're looking for Washington, D.C. to be a pretty average metro in 2012. In a year that average is actually very good, look for rent growth just under the 5% mark. And that wraps up for Washington, D.C. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.